Well, welcome everybody to the Value Add Strategy Podcast, where we inspire entrepreneurs through real life stories. I'm joined today by Keith Misner. Am I pronouncing that right, Keith?
You are. The spelling might suggest otherwise, but you did it great. Thanks.
Perfect. With the Attainable Housing Collective. And Keith is an entrepreneur, has experience in the brokerage space, multifamily space. Presently, he's involved in adaptive reuse, RV parks, manufactured housing, and we both have a like-minded kind of initiative towards affordable and attainable housing, which we'll get into on this discussion. But I wanted to thank you for joining us today, Keith.
Well, it's my pleasure, Matt. I enjoyed getting to know you from afar and enjoying getting to know you in more detail now too.
Well, likewise. We're excited about perhaps joining forces in some way, shape, or form in a relationship towards, generating value for our investors through this affordable housing initiative. So with that, let's talk affordable housing. Tell me a little bit about your background, how you got started in the business, and kind of where you grew up and all that good stuff.
Yeah. So you have this fast. It's 35 to 40 years is probably the better number to say a real estate career is happened already. I mean, wow, how did that happen? I grew up in Northern Virginia, right outside Washington, D.C. My dad was an architect. So I was around and then developer because he was like, hey, all these people are making all this money. And in Northern Virginia was, and it still is, exploding growth. And so it was a good place to be in that scene of growth and in commercial real estate. And I had been around it my whole life. And so it was natural for me after college and then graduate school to kind of stay in real estate. I've been around it. And I've always been based in the Northern Virginia area, or really Annapolis, Maryland, which is a cool town to be based in. And if I put my career in two big buckets, one is commercial real estate brokerage and national leadership and brand building and capacity building. And the other one which was in between two big bookends of commercial real estate leadership roles, was transactions management strategy, portfolio asset management, portfolio creation for publicly traded REIT, that happened to be Inco, and then pension fund advisory work, including fundraising with pension funds, and then deploying the capital, value add, and core plus strategies with my partners at a great company called Abacus Capital Group.
Nice.
So I've been the servicer of products and strategy, and in between, helping programs grow those programs. Plus, I grew the portfolios themselves and all that within huge, most of it is apartment space.
So right now, and that's an unbelievable background. Right now, you're raising capital, I understand, mostly from high net worth individuals and family offices.
Correct. So what I in the past year and a half, when I've kind of at this stage in my career where I've kind of out of the corporate world very successfully and happily, and I kind of want to do something entrepreneurial. Don't let a market cycle go to waste. And I figured, Matt, I would just go straight into apartment and create a fund like I always had. And I have a home in Vero Beach, Florida too. And I was down there and kind of looking around and needed a ladder, drove by and bought a used ladder from a guy in the double wide. And I was talking to the guy in the double wide, and then I leave that meeting and I pick up my used ladder, and I'm driving home. And of course, what do I see? Everywhere, which I had seen before, but I see even more so. Nothing but manufactured housing communities, just everywhere. And I don't know, and I know much about them. I knew it was a land lease model and all that, but I didn't know much. And so I drove through a bunch. I talked to people; they were all happy and friendly, and I was just kind of enamored. And I came back to my house and I said, I'm going to learn about that. And it turns out the Manufactured Housing Institute's Congress and Expo thing was in Las Vegas in 2 weeks from that day. So I was like, hey, honey, you want to go to Vegas? And she's like, no, I don't want to go to Vegas. And I'm like, well, me neither, but I'm going to Vegas to go learn about this space. And kind of the rest is history. I took every course I could. I sat in every breakout. I met people that I knew. I knew people from my career in the space. And here we are.
Yeah,
I remembered by it.
It's really an unbelievable industry. I've been involved in manufactured housing investing since 2007. And I could tell you it's really a small world out there, unlike multifamily. A lot of the players know one another. If you're in brokerage, you know who's active, who's buying, who's allocating capital, who's looking to dispose of assets, who's a good operator, who isn't. So, word spreads very, very quickly, which could be a great thing. And it has been in our case, and not so good a thing if you're not the best of operator or you don't do what you say you're going to do. So that would be a little bit on my 2 cents from going to MHI and networking with other owner operators and others that are in the space.
I agreed. And the takeaways after that meeting, and then I went to IMN and a bunch of other conferences and just immersed myself in the last year plus in the space and getting to know people, was there are just wonderful people in this space. There are just wonderful people with a bit of a mission driven or an altruistic kind of aspect to what they're doing and why they're doing it. Now, it's a business at the same time, but I really enjoy meeting the people with that extra added kind of capacity and need to fulfill that need for themselves. And that's who I'm attracted to. And so I'm here chatting with you, Matt. And that's what I'm attracted to. And so what I was going to do is buy a manufactured housing community, or probably a mobile home park. And I had a couple of friends they were executives at big companies, basically figuratively grab me by my back of my neck and pull me back out of the pool, if you will, and go, no. You aren't going to go buy it. What you need to do is go work with the people that already learned how to buy them and operate them, because the learning curve is massive.
Yeah.
And I took that to heart.
Well, it's very, very hands-on is what I could tell you. And it takes years to make mistakes in order to really refine your operating efficiencies. So I think your friends gave you a very wise piece of advice, not to dissuade anybody from being an operator. It's just the learning curve is rather large, as you alluded to. And I've definitely taken my lumps over the years. And I think that's the advantage for my investors, that they're buying into a seasoned operator that's refined those systems, that sees the pitfalls, that understands how to underwrite deals, that understands how to operate effectively, rather than starting kind of from scratch. So I think your friends gave you a very wise piece of advice there.
And definitely, and a little bit of where my value add could come in capacity to be effective. First and foremost, I just view myself as an advocate for the space. I like talking about it. I like waving the flag, and I like going, and we can go into it in more detail, but it's not what you think. I say all the time, it is not what you think. And give me 10 minutes and we'll go through some anecdotes of what I had to learn, because it's not what I thought. And then when you get to the kind of the end part of that, it's so much better than I would have thought, actually, like 10 times better than what I thought. And then add on you can feel good about what you're doing at the end of the day too. So that's pretty.
Yeah, it's tremendously rewarding. I could tell you personally, being in this industry, you mentioned a word, altruism, which I tend to agree with. People in this industry, they're looking to help one another, because it's going to help them in the long run. And B, we're looking to help the residents. Unfortunately, there are a few bad actors out there that have taken advantage of some of the supply and demand characteristics that do exist. It's very challenging for folks to move their home. And unfortunately, some unscrupulous operators take advantage of that aspect, and they really push rents beyond where markets are. But then on the other side of the coin, and I would say the overwhelming majority of operators really are smart, they are responsible, they care about taking care of their residents, they care about providing their residents with a place that they're proud to call home, to build that pride of ownership. And most importantly, offering them the American dream where it doesn't exist anywhere else. These folks can't go out and buy a stick-built home built by Lennar. The average price of a home, I read this morning, I think is $480,000. These folks, especially now you're talking about 6.5% interest rates, people can't afford that, but they can buy a beautiful double wide in a community with a clubhouse, with a fitness center for $125,000, and they build equity in that home, especially when the ownership groups takes care of that community. They invest back into the roads, into the infrastructure. And when they go to sell down the road, once everyone else keeps up their home as well, they could sell that home in all likelihood for more than what they paid for it. So they didn't throw their rent away. Yes, they have to pay their lot rent, but we're providing something that's niche that nobody else can. And it is tremendously rewarding. And if it's done right, not only is it a great thing for the residents, it's a great thing for the ownership as well. It's a win-win. It's tremendously profitable.
I say all the time, it's all stakeholders can win if it's done thoughtfully and with a bit of with a very good program in place, and just thoughtfully with a time horizon that's reasonable.
Yeah.
And in fact, if that's done correctly, and let's just use 3 to 4 years to get a park that needed some capital, some value add aspects, to be able to get the lots that can be raised to market rate raised. And there's probably going to be a few, and I don't want to put words in your mouth, but there's probably some residents there that you're just going to help a little bit because it's going to help you run the park better. In other words, help them in that, yes, they need to kind of get as close to market as they can, but fixed income, some other things like that. You're creating the community, and the community is going to surround themselves around that person too. And you just have to be patient about the financial aspects, because the reward comes in so many ways, and it's financial at the end of the day. I don't want everybody to think, well, we're doing this just so we can have a big heart, right? And we can, if you do this right, you're going to have a community that you rent the land, and that's number one. People a lot of times don't understand. They look at the cover of the book and they look at the picture and they go, I don't want to own that. Well, you don't own that. You own the land typically, right?
Yeah.
Pure sense. And you rent the land, and then your job is to create the community and create an infrastructure, have a safe, happy place for people to live. And then all of a sudden they'll start to reinvest in their own homes again, and they'll do other things. And maybe you can help them out a little bit, and then everybody feels happy about it. And over time, lot rents can be raised to market, and it's a good thing. But it has to be over a period of time. It's not a quick hit anymore. When did you buy your first? When did you buy and start operating your first community?
Back in 2007, I bought my first community.
Okay.
So pre-financial crisis.
Yeah, and not as many people were looking at the space by any stretch, right?
No, it's when I got started in this industry, Keith, it was interesting. This was not a well-known asset class. I got involved in both MHC and storage. Neither were well-known. They were both very niche, very fragmented, as they still are today. Don't get me wrong. But there really wasn't much liquidity in the space. So, you didn't have institutional capital, couldn't really get loans to purchase these communities. It was more seller financing, or you could find a local bank. Nowadays, you have the agencies that have a very high appetite to lend debt capital on this asset class. And you've got institutional capital that very much wants exposure because they understand how compelling the asset class is from a long-term perspective and those supply and demand aspects. And they're smart for doing so. Makes it a bit more challenging to go out there and find real value. So that's going back to what your friend said about operating. The other thing is finding great value in the marketplace has gotten more challenging than it was in the past. In the past, it was shooting fish in a barrel. I mean, you could almost go, I hate to put it this way, but you could buy almost anything just because there wasn't as many buyers. There was probably a tenth of the buyers that there is today when I got started. So you have to be that much better of an acquirer, of an underwriter, of an operator to really drive value. Back then, you couldn't get capital. I couldn't raise equity to buy these deals. I couldn't get debt. So it was very relative, but I bring all this up just to show the evolution in terms of interest and capital flows over the past, 18 years since I've been involved.
Yeah. The maturation, it's all this stuff is cyclical, right? And so clearly MH is in its beginning of its third phase, right? It's maturing, and it's good that there's takeout capital there and the GSEs are there and all that stuff, but it's bad because it's not the Wild West like it was when you got in. But that was bad because the capital wasn't there. So
that's right.
Life is full of these things that never really equal out. You want to get, there's always pushback from investors I talk to, and they go, well, but it's not like it used to. And I was like, but the exit capital is there now. And therefore, and I would say the quality owner operators actually know how to do it. There's technology helping them out now. There's a whole bunch of stuff that's better that my kind of takeaway when I meet with people is they go, what? And I go, I believe, and I think we can show financially, statistically with spreadsheets and underwriting and everything, that the risk profile of a well-run, managed, manufactured housing community that's 3-star or higher is a lower risk than a Class B apartment complex.
Yeah, I'd have to agree with you. I mean, it's a lot easier to manage, number one, because you have lower operating costs, lower operating expenses. You don't have to invest as much CapEx. I've owned multifamily, and it's a great asset class. Don't get me wrong, but it's more management intensive. When somebody moves out of an apartment, typically you got to turn that unit over, put in new paint, new carpet, new sink. You got to really invest in that particular unit in order to re-rent it. And MHCs, they own the home, as you mentioned. So typically when people move out, they sell the home to another third party who comes in and just continues to pay you that lot rent. So it's a lot different process.
It's a different process. And then there's the whole supply side.
Oh, absolutely. I mean, you
That
got
park
new
space will get new apartments the nanosecond the supply and demand and or capital inflection allows it to happen. Now it's all out of whack right now because of interest rates and tariffs and a whole bunch of other things, but they've overbuilt. I mean, that is a overbuilding and not as way overbuilding and then not nearly as way overbuilding as the apartment. They're always overbuilding.
Yeah.
Okay. You're not overbuilding manufactured housing.
No.
It's in fact that the supply, if anything, is consistent or shrinking because at some point in time, some other use of this land, no matter where it is, may just kind of economics cause it to do something else. Or, Matt, capital doesn't come and invest in the park early enough to save the park, and the blight is too big to where the local government and everybody's just like, we're done with it, and we're not gonna let it happen anymore because it's gonna, that in those instances, which is unfortunate, it lives up to the stigma.
Yeah.
And I talk about this all the time, bringing capital into the space, preservation of these sector is critical to actually the health of the economy in a way, because there's 50%. It just Harvard just came out yesterday with their annual big kind of report on state of housing in the United States. 50% of renters are cost burdened. And cost burden means they are spending more than 30% of their gross income for housing. 50%. A quarter of all households are extremely cost burdened, which means they spend about 40 or 45%, or no, 50% or more of their annual income on housing.
That doesn't leave very much money left for food and enjoyment.
And these when done right and can be preserved, a lot of times they are the last stop of people before they go into really blight, or they can be happy, nice places that are 30% the cost of 1,200 square foot home elsewhere. And you get 4 walls. Nobody's living above you. Nobody's living next to you.
Yeah.
You can play in a yard. You get that pride that everyone wants.
That's right.
That's where I start to get excited, is like, and we can all make money. Just be patient about your ability to make money.
Yeah, this is a long-term game. And guess what? I mean, if I go back in history, if I have one complaint being a fund operator and being a sponsor of a fund, you have to sell. These vehicles are finite. You can't hold assets forever. I can't tell you how many times I look back on the assets I've sold. And by the way, during the time in which I've sold them, I thought to myself, wow, this is a great deal. We're booking a 30, 40, 50% internal rate of return for our investors. This is fantastic. But inevitably, a couple years passes, 2, 3, 4, 5 years pass. Rents continue to grow. Demand for these communities continue to grow. I look back and I kick myself and I go, man, what if I kept that? It'd be worth millions more today. But you know what? So is life. That's the nature of the business, and that's the nature of, raising capital within a fund structure. I can't.
So it's funny, for 20 years of my professional life, I was a national leadership seat for national commercial real estate brokerage companies, Cushman, Wakefield, and Brigade. And we like transactions. When you're in that role, you like transactions. You like the fund model. You like that, and it's the fund model is not going anywhere. Okay, capital loves to go in and out of things, and that's how people feel that they're getting that because you have to crystallize the event, so then you can go get more money again. That's the fund manager's role. Okay,
Sure.
and when I pivoted when I first did this, and I've raised for a couple operators. It was all accredited investors, friends and family. You got to start somewhere, right? And so I started advocating in friends and family, and I raised an SPV and we invested. And then and that was harder than I thought because I thought everybody would just believe me because I got all excited and I say what the thesis is. So I had to learn a little bit, right? Which is fine. There's no race for me. I'm doing this because I want to, and I get to do it with people that I want to do it with. And then I was like, all right, there's an easier way to do this because I want to invest with people that have a longer term horizon that already have a somewhat understanding of what alternative investing is. Because our sector is an alternative within the alternative sector.
Yeah.
So I had switched my transitioning to, and you already mentioned it, to really focusing on high net worth and family office and partnerships and long-term and bigger checks and true almost programmatic. And kind of a little bit is like, well, we don't really want the money back. We want it to stay in the system and continue to the real estate system. And we can get into depreciation and a whole bunch of fun stuff like that. But
Tell us about that educational process, Keith. And Terry, you mentioned, the long-term nature of this business and how value is created over the long run. How have those conversations gone with your limited partners or your potential limited partners? Did they immediately get it? Did they say, "Hey, I'm looking for a quick buck"? What does that education look like?
so, all right, there's the funny thing I just thought of. In my Rolodex, right? I'll be an old guy and I'll say I have a Rolodex. And so I go out to a couple hundred clearly wealthy enough people to invest $100,000 minimum into a fund I'm forming. And most of them have, as I imagine, they're real estate people. So I'm like, oh, they're going to get this. Well, it turns out those real estate people really had to be educated. And when I really did a debrief afterwards, I was like, you know why they were struggling so hard to do it? Is they are used to being the GP.
Mm,
For them to be in an LP position was very hard.
sure.
Like, well, how do I know if Matt and the team are gonna, or whoever, it wasn't you guys at that one, but how do I know if that management team's doing it right? And they would go look at the underwriting and we're like, why are they underwriting? I'm like, stop. We're investing in the thesis, and then that company's ability to make value in that thesis the way we want them to.
Yeah.
We're investing in the infrastructure. So that was one learning curve. The other learning curve, so that's LP versus GP. The other learning curve is people, they just judge a book by its cover. And that's just a human nature thing. They're like, no, I know that it looks like risk. And I'm like, all right, well then let's just slow down and let's walk through what the thesis is and what the reality is, because I thought the same thing. And I'm going to explain to you what I went through after going to conferences and stuff like that. And then by the time I got to that point, my funding time, big picture is I was getting close to I need you to kind of soft commit. And they were like, well, now I need to understand the operator better rather than the thesis. And I kind of ran out of time. That's why shifting to high net worth and family office, where they already know that they have a wheel of investment and they know a sliver of that or a piece of it is going to go into alternative investments. And then attainable, right? And then you have to say, okay, well, you're already in an apartment or self-storage or whatever you're in. Have you considered manufactured housing? Have you, or attainable anything in my world of kind of cost effectiveness? I try not to use the word affordable too much, because if people do know, then they immediately go into, oh, well, that's LIHTC and HUD and HAP contracts and all this other stuff. And I'm like, that's not what I'm focused on. I'm focused on naturally occurring properties that solve for cost effective housing. The government programs do, they attempt to bridge the gap, and they do bridge the gap eventually when they get done, but they're very time consuming and very expensive to get there. So, and there's nowhere near enough of them to satisfy the demand for the bridging the gap.
Yeah. How would you define the difference, if you had to sum it up in a few sentences, between affordable and attainable? And why did you name your company Attainable Housing Collective?
Yeah. Well, full on to that initial MHI Congress and Expo I went to in Vegas in 2024, I heard the word attainable used all over the place. So I was like, okay, that I liked it. It kind of fit. it kind of checked a lot of boxes. It's here and now. It's the preservation. It's doing its job right now. You have to put a little bit more money into it to not let it slip away. Is what.
Yeah.
So it's attainable now. We can get going right now. The affordable part in my background, maybe it's just me being biased to commercial real estate and, running big companies and being so enthralled and intertwined in commercial real estate. Affordable to me just means like government programs. And so I probably am biased that way a little bit. But I still, again, I like the cost effective because it makes people go, explain cost effective. And I'm like, well, that's the attainable. It's here and now. You can build new houses. Somebody once tell me, and I'll leave the name out of it, but kind of the problem with cost effective housing, this is years ago in my career, it says you can't build new used apartments. If you could, you would, because the demand for cost effectiveness is through the roof. There's insatiable demand for it. So why can't we just go build something new and charge a lower rent? Well, it's because it costs too much.
Yeah.
So now this is preserving is the very closest version I can get to solving for not letting it go into obsolescence. Stop the obsolescence. That's building it. It's because of not letting it go away. But then I would also say, and I'm in discussions and I'm meeting with a couple of factory built home folks that are getting ready to come to scale, and they're at scale. They're doing their thing, but they can be part of the solution because there's lots of them, and there's all these new technologies, whether 3D printing or steel homes or boxes, or modular or panels, and I mean, you can't get enough of those innovative ways to build housing that's cost effective. There's no way you could build enough of them. And there's pushback from home builders. There's pushback from zoning. There's pushback from building codes. It's just a complicated weave, but a couple of them are gonna make hay and be able to sell what their factory can produce to be either do apartment buildings or I really think build to rent could benefit from it. So I'm talking with them to advise and help. So that's another one of the ways you can solve. You actually might be able to solve you can't build new used. Technology and innovation might be able to help you build even more. Now the traditional manufactured housing, the single wide, double wide, quad wides, the mod wides, all this stuff they have are cranking along and they're selling as much as they possibly can. But there's even newer ones that are even less expensive and easier to transport. That I think are going to be
nice. One question I had for you is you mentioned and you notated that manufactured housing ranks number 2 in cumulative commercial real estate price appreciation over the past 7 years. Maybe you could talk about that for a minute. And I'm just for my own curiosity, what was number 1?
Industrial.
Okay.
Yeah. So that stat is from NCREIF, and NCREIF takes all the publicly available traded companies and then just does all these analytics based on them. And the good news, so that's one of the eye-opening things where people think they know about manufactured housing is, and I was like, well, let's just talking like we are, and I'm like, oh well, there's a couple of big real estate investment trusts, and they're like, oh, well, they must be new. Like, in fact, one of them has been around for 35 years, and one of the most famous real estate investors and creators in commercial real estate ever started it in Sam Zell.
Yeah.
And they're like, what are you talking about? I'm like, yeah, he never really talked about it. But if you look at the returns, I'm going to suggest it was, other than the guy being brilliant and timed everything a lot really well, he was no dummy. He never sold his REIT. He sold his other property. He never sold his manufactured house.
Well, he timed that office REIT equity office to Blackstone back in 2007. His timing couldn't have been better.
That's crazy. Crazy.
But ELS, which is still in existence today, which, by the way, I think for a time, and still may be the case, was the number 1 performing equity REIT across the entire index. And what is that?
Which is part of the statistics that drives the stat that you're talking about, because the NCREIF uses all this publicly traded company data and then does it by sector. And it says, well, who's been, and it's because industrial and manufactured housing are recession resilient.
Yep.
Because their demand tends to stay through the recessions and or the economic cycles. And it's kind of like gravity. It's kind of like cost-effective housing demand is insatiable.
I would argue
you can't.
I would argue manufactured housing is more recession resistant than industrial any day of the week.
The industrial, I went through, and it's again with data centers, it seems to always had this kind of cool thing that helped it with just in time and all the delivery mechanisms with Amazon and all that stuff, it kind of made, and then the globalization of real estate, manufacturing made, storing the stuff either medium or long term or very short term kind of a thing. I remember when I was at Cushman and Wakefield, that was all becoming known, and we created a whole industrial division.
Yeah, I would say
On that,
e-commerce was more of a boon for industrial than anything. Fantastic asset class, not taking anything away from it. But
of course.
back to Sam Zell. Now, is it a really interesting story? Did you read his book? Am I being too subtle?
I did not. I should.
I would highly recommend it. He's got a chapter about how he got in the industry. I won't ruin it for you, but it's very intriguing and it's very inspirational. And I actually met Sam once at a SALT conference in Las Vegas a couple of years ago before he passed away. I saw him at a breakfast. Nicest guy. We talked for about 5 minutes about the industry, how he got into it, his background, and yeah, it was really a memorable moment for me personally.
In my career, I worked closely with in a dozen people that came from working down the hall below, well, probably not above, but down the hall or on a floor one or two below him in one of his organizations. And they all just learned so much. And we're just like, the guy was a great leader. He was hard charging and task driven, but that made everybody better. Right. And so, yeah.
I think one of the characteristics about a great leader, maybe it's not going to be your best friend, but it's going to make you, if they make you better consistently, both professionally and personally, that's the sign of a great leader at the end of the day.
Yeah. And I've had the privilege to be around every place I went where I was surrounded by, and everyone being different, of course, but just great leadership with great vision and great thoughtfulness. And, that includes making hard decisions. That includes embracing change. That includes what's right for everybody. Is sometimes change is right for everybody. I'm better for change. And I've been part of the people who've been able to make change for people. I hope I'm part of the people on the good side of the ledger on the leadership thing and saying, well, not only were you a good guy, but you helped me do what I was supposed to do, and I'm better for it.
Yeah. Hey, that's why we're all here, and that's why we're signed up to be leaders at the end of the day.
Yeah.
So in conclusion, I'm just curious your idea, your thesis, or your vision of where this industry is going to be, let's say 5 or 10 years from now, and where are you going to be in terms of where you see the industry going 5 or 10 years from now?
Good question. It's in its maturation. I think it's in its beginning of its final third phase of maturation. So the lowest hanging fruit is going to be harder to get. You're seeing it every day with trying to get your properties.
Yeah.
I think therefore operations and investment hold periods are longer. And I think that's better. I think a 10-year hold is better because we're going to have to recycle the money. And by the way, we didn't even go into the details, and we'll see how the tax bill comes out. But if accelerated depreciation comes back, I mean, you want to hold these things for a while so you can take advantage of that, and from operational standpoints, right? And so I think that would be all positive. I think the cream will continue to rise to the top in the industry, and the good news is there's a lot of cream. There's a lot of people like you and your organization that are doing it right and doing it well and doing it thoughtfully and with that bit of altruism at the end. And that'll just snuff out the others. The others will just be kind of, well, they're going to do what they're going to do anyway, so it doesn't matter. Just don't let them drag you down, right?
Yeah.
Don't become dependent on that.
The way we see it is interesting. We always call it, we're a value add organization, and that's the name of the podcast, the value add strategy. But that's really fundamentally who we are at the end of the day. We're considered a value add investor. And we summarize that in levers to pull. There's various levers that you could pull to create value. By far the easiest one is just raise the rents. That gets people into trouble when they don't do it responsibly. But I think tying into your long-term vision, which I tend to agree with for this industry, I mean, these assets are probably going to need to be held for a longer period of time, which is okay. I think you'll make more money with that mindset and that philosophy. But you're going to need to be a better operator, and you're going to need to pull other levers than just, hey, time to jack rents up. That's part of the business, don't get me wrong, but do you have a means and a mechanism to bring homes into communities, sell those homes to grow occupancy? Do you have a means to build back utilities? Do you have a means to reinvest back into roads and infrastructure? I mean, those things are going to separate, like you said, the cream from that cream rising to the top versus all the rest that may not do so well. So you're going to have to be more than a one-trick pony of pulling that rent increase lever, and you're going to have to learn how to do those other things. And if you're not an owner operator, do your research, which it sounds like you're doing, in terms of finding one that could pull other levers to create value, that has a long-term vision. And I really hope that you and I could join forces. And it sounds like we have a lot of commonality in terms of where we see the asset class today and the opportunity and the upside and the growth. I think it would be a lot of fun to go on that journey together to create value.
I look forward to it, Matt. Good people doing great things is where I'm at in my stage of life, in my career. And I'm fortunate to be able to co-invest with people that I invest with, and I'm having a ball doing it. So I look forward to more and more and more.
Awesome. Well, it was a joy and a privilege being here and chatting with you today on something that we're both very passionate about and believe in very much, which is the manufactured housing asset class. And I look forward to continuing this discussion.
Yes, me too. Thanks, Matt.
Thanks for being here, Keith.